Gresham College presents Unweaving the Anti-Money Laundering and Counter-Terrorist Financing System by Dr. Dionysios S. Demetis.
Well, good evening, ladies and gentlemen, and welcome to Barnard's Inn Hall. This is the first Gresham lecture of 2012 in the old hall, which we know and love. But as you're well aware, things have become very crowded at many Gresham lectures, including, I'm delighted to say, this one. And we are using the Museum of London. For those of you who don't know me, I'm Michael Mainelli. I'm the Emeritus Professor of Commerce, one of the Fellows and Trustees here at Gresham. And it's a real delight to welcome you to a lecture that I had a small part in arranging. It's really because a dear old friend of mine is speaking tonight, Dionysios Demetis. Many years ago, I did a study for the City of London Corporation and the Institute of Chartered Accountants in England and Wales. And this was just after the events of 9/11. And we were looking in 2003 at the costs and benefits of anti-money laundering. And that study, which is very old, is probably still true. We were unable to find anything but costs. And I think what's interesting tonight is that Dr. Demetis has decided to tackle that straight on the head. Now, Dionysios went to the London School of Economics, as did I. He leads the Anti-Money Laundering and Counter-Terrorist Financing Group at Syntax IT, which is a company based in Athens, Greece. Dionysios has asked me to emphasize that he's come here tonight, however, to deliver a private academic lecture and nothing to do with the business. So sue him academically then, please. Dionysios is a former physicist by background, and he holds a master's and a PhD from LSE in information systems and anti-money laundering. And his research on the approaches he's going to talk about tonight in AML have been featured by the United Nations Immelin Network and others. He writes copiously. He's the author of two books, one on tonight's subject, AML, entitled Technology and Anti-Money Laundering, a highly recommended book. And his publisher has brought copies tonight, and after the lecture, Dionysios will be happy to answer personal questions as long as you're holding a book that needs signing in your hand. His other book is published with Ian Angel, who is both of our advisors. Ian, show him a hand there. And Ian's a very controversial book with Dionysios is called Science's First Mistake, published worldwide by Bloomsbury. But I would really point out that it's free online. So Ian gave a lecture here last year, which certainly riled a lot of people, myself included, but it was most enjoyable. And finally, in this day and age, we like to have the little Easter egg option, the stuff that you can only find out privately and not on Wikipedia. Or it would have been better yesterday because you could find out nothing on Wikipedia. But Dionysios is studying currently for his piano diploma, and I'm the proud holder of two albums that he's cut, and I must say they're absolutely brilliant. So we have a very talented individual with a wide range of skills here to talk about a very interesting subject. And even when he lands on these very shores, there was an article published in City AM yesterday with the author himself on anti-money laundering, where he questions whether or not this is the way to go. So with no further ado, may I ask you to greet Dionysios Demetis, who will be talking about the paradoxes in anti-money laundering.
Well, thank you all. Michael, thanks a lot. Welcome. Before I begin, first of all, I would like to thank Gresham College for hosting this event, as well as all of you for being here. Quite unashamedly, even though Michael did mention it, I must say that to get better access to the full spectrum of ideas, a representative from my publisher, Edward Elgar, is selling copies of the book after the event. I've been informed that different forms of payment are acceptable, and no checks will be carried out on the source of your funds. So this talk is largely based on my book, where I analyze the multiplicity of technology-based influences on the domain of anti-money laundering, and where I develop a systems theoretical approach for the deconstruction of the anti-money laundering domain. Now, the work itself was triggered by a deep interest in a series of areas like anti-money laundering, information systems, and systems theory. What always seemed to be missing, in my view, was a coherent theoretical framework under which researchers and practitioners could unite on researching and describing the fascinating complexities on anti-money laundering. Now, in my talk, I will be discussing mainly about the principles of the broader anti-money laundering domain, some of the challenges on counter-terrorist financing, and I will finish the talk with some of the reflections on the risk-based approach and the difficulties behind its implementation. I realize that there are people in the room who've never heard anything about money laundering or anti-money laundering, so I'll break it down in under 2 minutes. Individuals and/or organizations engage in criminal activity that ranges from drug trafficking, human trafficking, extortion, kidnap for ransom, fraud, and the list goes on and on. When they do engage in such activities, they generate profits, and money laundering is essentially all about concealing and masking the origin of funds, placing them and integrating them into the legitimate financial system so that multiple benefits can stem from its use and can be enjoyed. To counter the dynamics of money laundering, a series of international initiatives have been created. The UN, the EU, the IMF, the World Bank, the Basel Committee on Banking Supervision have all weighed in with conventions, directives, principles, technical assessments, and guidelines. More importantly, the G8 endorsed Financial Action Task Force, or FATF, the key institution behind AML CTF efforts, has introduced 40 recommendations on AML and an extra 9 special recommendations for countering terrorist financing. Now, in order to be compliant to such regulatory provisions that gradually trickle down and form into national legislation, financial institutions must deploy a series of monitoring controls and practices, and these, or at least some of these, include Know Your Customer principles, or KYC, exercising customer due diligence or enhanced customer due diligence, monitoring sanction lists for individuals that are designated as terrorists, monitoring politically exposed persons, etc., etc. But perhaps more importantly, they engage into the continuous monitoring of transaction data. And by doing so, they attempt to determine whether transaction data exhibits any signals and any signs for money laundering behavior. And this is where the fun begins. Because if a member of staff or a software-generated alert leads to a strong suspicion that money laundering could be taking place, then a suspicious activity report is sent by the money laundering reporting officer to a national agency that is known as a Financial Intelligence Unit, or FIU for short. Now, financial intelligence units are then responsible for the aggregation and analysis of all suspicious activity reports submitted to them by different institutions in a country. And in the event that a case involves multiple jurisdictions, then FIUs from different countries are supposed to communicate with each other for tracking down laundered funds. And while cooperation is important, there are circumstances that render it problematic. 20 years after the constitution of the Financial Action Task Force, the global fight on anti-money laundering and counter-terrorist financing is anything but global. An analysis on data from all nation states recognized by the UN reveals that there is a significant number of countries that haven't got any financial intelligence unit at all. Other countries do not adequately report on their activities, and many more are not even part of the Egmont group, which is the group that joins FIUs together. But even in those cases where financial intelligence units have been established, one can witness a great deal of variation in their reporting structures, while a few lack the capacity to carry out work for analyzing multiple reporting sources of money laundering. Quite simply, if they've got Bank A reporting person X as a suspect for money laundering, and then an insurance company B reports that same person, there is difficulty in putting the two together. When cases involve multiple jurisdictions where different financial intelligence units need to cooperate, and exchange information for money laundering cases, then it has become standard practice for FIUs to negotiate and sign Memoranda of Understanding, or MOUs, for the exchange of information that would lead to successful money laundering investigations, prosecutions, and confiscation of assets. It sounds rather simple that FIUs would and should cooperate, but a remarkable complexity emerges out of it. A visual representation is perhaps the best way to see how this complexity evolves when more financial intelligence units need to sign MOUs between them. Each link, in this case, represents an MOU that needs to be signed for the exchange of such information. In fact, if all the countries in the world did have operational financial intelligence units, which is currently not the case, and they continue to engage in this process, then this is how the whole thing would look like. Now, a little more than 18,000 MOUs would need to be in place. Of course, there is still hope. According to quantum physics, somewhere in a parallel universe, some international institutions could be getting this right. But perhaps a brief informal incident highlights this part of the complex AML system better. Last year, I was chairing a panel session at Cambridge University for the International Symposium on Economic Crime. And after the panel and over drinks, I was having a discussion with a judge who suddenly asked me, "Do you know why criminals will always be one step ahead?" So, naturally, when I complied with the rhetorical request and asked why, the judge retorted with a lovely quote and said, "Because criminals don't have to sign MOUs." Now, taking this line of thinking one step further, it really isn't about the MOUs alone. This type of complexity is propagating across different applications and domains. It characterizes the broader entropy of the legal system, a system that attempts to define the distinctions between legal and non-legal. And in doing so, it creates a paradox. According to Niklas Luhmann, while the distinction between legal and illegal can be maintained, the legal system as a unity can never decide the basis of what is legal or illegal. It can never apply the code to itself as a system. There is no foundational value establishing what is legal or illegal, only operations. And this exposes a remarkable paradox and a unique self-reference within the system of law. And this is always underpinned by a paradox, because it enables the legal system to operate legally by declaring that something is legal or against the law. But is it the legal system that defines money laundering and consequently anti-money laundering? What other systems are distorting and reshaping the legislative designations by infiltrating the heart of any distinctions being used, as in the case of AML, the distinction between suspicious and non-suspicious behavior? One thing is certain, that the complexity and the expansion of the legislative provisions is not to be underestimated. The sheer number of entities that are obliged to exercise vigilance and report suspicious behavior for money laundering has expanded dramatically. Now over 50 distinct institutional roles report suspicious activities besides banks. And this includes accountants, building societies, exchange bureaus, insurance companies, the security sector, money transmitters, solicitors, and the list goes on and on. But while the vast majority of suspicious activity reports comes from the banking sector, there is increasing reporting from other entities as well. According to the 2011 annual report from the Serious and Organized Crime Agency, or SOCAD, which is the UK FIU, a little more than 192,000 suspicious activity reports had been submitted by banks, which is accounts approximately to 83% of the reporting activity, while a collective 18%, amounting to about 30,000 SARS, comes from other major reporting entities. And the figures I've used here do not include very low volume SARS submissions by other reporting institutions and entities like the security sector, auction houses, etc. Now, while the central role of banks in the broader financial system justifies this difference, it didn't used to be like that. A few years ago, bank-generated SARS would account for almost 98% of all reporting activity. Now, this demonstrates that new reporting entities are coming into the game and that money laundering activities are exploiting and entities that are peripheral to the core of the banking system. But there is a more general point to be made here. Year after year, and for the best part of a decade, the number of suspicious activity reports received by the UK FIU has been increasing, and a similar increase has been experienced by most financial intelligence units around the world, and the US follows a similar pattern. Now, this general increasing trend could be interpreted as leading to more cases through the extraction of useful intelligence, or alternatively, as constituting white noise. Even though there are other reasons that have contributed to the increase of suspicious activity reports. The increasing number of reporting entities, the continuous training on AML, which is raising or has raised the bar of awareness and increased the propensity of staff to report. Compliance fear, of course, is another one that has kicked in. But one of the basic theses that I pose in my book, and I have gone to some length to justify that, is that there is indeed another very, very important reason behind this increase, and one with a fabric of fascinating consequences. And that one is technology. In particular, transaction monitoring software that attempts to simulate money laundering behavior by using sequences of transacting patterns, common money laundering typologies, and so on. Now, I've got to say that I find this type of technology fascinating, as it effectively abstracts the expectations of how money launderers would transact and encapsulates those in a series of algorithmic queries. In my book, I have made the case that the whole spectrum of different types of information systems come to influence the basis in which money laundering suspicion becomes constructed. And these include case management systems, different communication systems, intranets, customer database management systems, electronic updates, and naturally, transaction monitoring systems. But when it comes to transaction monitoring, three interlinked aspects come out. First of all, there is a lot of raw transaction data that one has to manipulate in order to find suspicious cases. Secondly, we do our best to come up with algorithms, patterns, queries, thresholds, and so on, techniques that will model the behavior of money laundering. And finally, and more importantly, money laundering analysts are forced to do that every day from the many suspicious cases generated by transaction monitoring systems. Enter the concept of the true positive rate, calculated in many cases as the ratio of the number of truly suspicious technology-generated cases after manual analysis from staff to the total number of generated suspicious alerts by the transaction monitoring system. So, for example, if the transaction monitoring system generates 100 suspicious cases and only 10 of them are found to be truly suspicious after manual analysis, then the true positive rate is 10%. The remaining 90 cases are what we would call false positives. Now, at Syntax, we have been running a survey on the type of technology being used, the effectiveness of AML technology and how that is viewed by banks, the true positive rate of their software, what they think of regulators, and if they've helped them at all in the modeling of money laundering behavior, and finally, how many queries they actually use to profile money laundering behavior. Now, 82% of financial institutions have bought a transaction monitoring technology on AML from a software vendor. 9% developed it in-house, and even more interestingly, another 9% had more than one transaction monitoring systems. Now, when asked what they thought of the operations of the AML CFT software of the financial institution, 18% indicated that the whole project was a disaster. Another 27% said that they had a very large number of false positives. 36% said that they had customized the software, but it has been rather successful and still far off from working properly, and 18% claimed that they couldn't be happier. But what constitutes a successful story can carry different interpretations, and this is revealed when asked about their true positive rate. Now, 30% responded that their true positive rate was between 0.1 to 1%, which is the green segment, with an extra 10% having a rate of less than 0.1%. Then we have rates between 1 to 5% with a collective 20%, and the remaining 40% having a true positive rate above 8%, but mostly limited to an upper threshold of about 10%. We had estimated that in an average case of a bank that had an 1% true positive rate, that bank was spending approximately $350,000 to $500,000 a year just to examine false cases that would be generated by the software. Then we asked, what was the case when regulators came in for an information systems audit of the AML transaction monitoring systems? In 30% of the cases, the regulators were perceived as ignorant and having no mechanism whatsoever of evaluating AML technology performance. In another 40% of the cases, regulators were perceived as understanding, but having done nothing practical to help. And finally, another 30% were perceived as helpful and provided active advice. But every monitoring technology is based on queries, rules that attempt to algorithmically simulate money laundering behavior and connect together characteristics and parameters. And this is basically the DNA of modeling suspicious behavior for money laundering. And while vendors usually provide plenty of predefined queries, we asked financial institutions to tell us how many they were actually using. And here the answers were as varied as you can possibly imagine, with some people replying that they used 5 rules to simulate money laundering behavior, and others replying 20, 48, 100, 180, etc. A whole ecosystem of responses indicated so many different approaches, and these made only one thing clear, that when a lot of different remedies are suggested for a disease, that means the disease can't be cured, as famous novelist and Dr. Anton Chekhov wrote in his last comedy play, The Cherry Orchard. Now, speaking of diseases, there is another resilient one by the name of terrorism. Of course, one that its semantics do depend considerably on the political influences exerted to it. But by stepping up the monitoring efforts on counterterrorism, a number of unintended consequences have emerged, and false positives are present here as well. 2 wonderful examples can be found in the US no-fly list. Sister Glenn Ann McPhee is one of them. Not only was she a nun and the head of Catholic education in the US, but as Wire reported, along with many other media sources, she was also a designated terrorist for 9 months. Now, after dozens of missed flights, she made numerous complaints to get off the no-fly list, but she couldn't, until some high-level political contacts assisted in the process. And the false positives backlog at that time had a 13-month wait. Another one that some of you may have seen already apparently exhibited an even more suspicious behavior was Alicia Thomas, a 6-year-old girl from Ohio that was placed on the terror watch list, causing airport havoc whenever her family would fly. But how would a 6-year-old end up in the terrorist watch list? When her father was asked by Fox News reporter, what could she have possibly done, he responded with a sense of humor and he said, well, she did threaten her sister once, but I didn't think this would become a homeland security trigger. But you see, such are the troubles of false positives. Since 9/11, the introduction of the 9 special recommendations on counter-terrorist financing from the FATF have certainly made their mark. And in my book, I used a rather provocative heading for the section on counter-terrorist financing and called it a farce. Retrospectively, I was right. But even so, it was not within my intentions to scathingly dismiss counter-financing terrorism efforts, but to contextualize their behavioral monitoring problems. As a phenomenon, terrorist financing is considerably different to money laundering. This difference lies in the nature of the phenomenon itself, where legally earned money could be used to fund terrorist attacks, as well as the relatively low amount of money required to launch the attacks. For example, the London Underground bombings cost an estimated £8,000, according to the official report submitted to the House of Commons. Other approximate costs are listed in the table. The 9/11 attacks in New York cost between $400,000 and $500,000 to execute, according to the report submitted to the US Congress by the 9/11 Commission. Now, these figures make one wonder whether the mobilization of the global financial system is well worth the trouble when tackling terrorist financing, and even when some broader operational costs are considered on top of these, the problems remain. According to Parkman and Peeling, those sums spent by active terrorist cells on the preparations for a conventional attack are typically so small as to be mere droplets in the ocean of daily financial transactions. And this highlights the behavioral modeling problem further. Typological confusion makes matters worse. It is almost impossible for financial institutions to infer terrorist financing behavior from transacting patterns. The thing is, even financial intelligence units are at a loss. Only 7% of the world's FIUs differentiate in their annual reports figures related to terrorist financing. How could any money laundering reporting officer have the solution to this? Even more disturbingly, the FATF seems to agree by stating the following, that it should be acknowledged as well that financial institutions will probably be unable to detect terrorist financing as such. Indeed, the only time that financial institutions might clearly identify terrorist financing as distinct from other criminal misuse of the financial system is when a known terrorist or terrorist organization has opened an account. Now, this quotation has been extracted from within the guidance notes for the detection of terrorist financing for financial institutions, and hopefully one spots the irony here. Of course, even the check and match process of the almost 900 sanction lists is not easy. This is where institutions have to make sure that they do not facilitate any transactions where sanctioned individuals or groups are listed. This comes with different challenges in the manipulation of the lists themselves, linguistic issues, considerable duplication of the lists where effort is required to consolidate and where basically the private sector comes in to assist financial institutions in that direction. But meanwhile, the automated manipulation of transactions for detecting terrorist financing is next to impossible in its behavioral sense. And from a profiling standpoint, the monitoring of terrorist financing activity raises more controversial issues. One such controversy involves the profiling of terrorist financing behavior when it resorts to discriminatory practices that often touch upon sensitive issues of race, nationality, and religion, resulting in algorithmic racism. The phenomenon where personal and sensitive indicators are embedded in algorithmic representations for projecting a probability for terrorist financing. And these associations effectively encapsulate terrorist suspicion algorithmically. This raises another issue on the data privacy aspects of handling transaction data for monitoring purposes. How individuals are profiled for either money laundering or terrorist financing, and what legal rights are transferred to database entries constitutes an emerging issue. Now, in the UK, the report of the Information Commissioner has highlighted a number of important issues for the handling of Elmer, which is the database where suspicious entries are registered at the FIU. But the European Union is also currently, and this is quite recent, is also currently turning its attention on this issue with the adoption of a number of recommendations related to data protection and preventing money laundering and terrorist financing. Now, on countering terrorist financing, though, a number of additional aspects are troubling. For example, what is the probability of a known terrorist or terrorist organization opening an account instead of having one of their non-listed associates do it for them? The lists are public anyway. Also, why not use a number of underground Hawala-type methods readily available for moving money around? That could explain some, at least some, of the disheartening results in counter-terrorist financing. Now, based on an analysis of more than 30 years of data, more than 1,400 terrorist organizations have been, and most still are, in existence. In that time frame, 12,200 terrorist attacks have been recorded, in which individuals from 169 different countries participated in the attacks. Now, this illustrates that there is a considerable geographical spread over those who are involved in terrorism, a geographical spread that comes into stark contrast to what organizations and countries are targeted for terrorist financing. For example, the Office of Foreign Assets and Control blocked funds is targeting just 8 terrorist organizations, and with 98% of all blocked funds corresponding to just 2 out of the 8 organizations, namely Al-Qaeda and Hamas. Now, the very fact that only $2,648 had been confiscated for the financing of the Taliban, according to the 2007 Terrorist Assets Report, makes a rather strong statement on how efficient the fight against terrorist financing has become. In subsequent reports, the figure was omitted altogether. Now, at the moment, there seem to be very, very few things that are actually working when it comes to counter-terrorist financing. And one of them involves the confidential briefings of compliance officers already subjected to the Official Secrets Act by the National Terrorist FIU of the Scotland Yard. At least my information is that very few intelligence agencies have given feedback of this type, and that a number of MLROs have found it useful. Now, naturally, all of the above problems on countering the financing of terrorism are usually suppressed. High-level institutional endorsement of the subject matter usually prevails over facing these practical consequences with a more pragmatic approach. And the introduction of the risk-based approach to anti-money laundering and counter-terrorist financing was supposed to be just that. Indeed, one of the most important evolutions for the handling of both domains. Now, in my book, I have dedicated an entire chapter in its analysis and reflecting on its implementation. But here I would like to discuss some parts of the anti-money laundering approach to risk in brief, and before doing so, reflect on both the nature of risk itself and the way it is observed. Now, risk is an important concept that is used in the vast majority of financial and other institutions and has influenced much of their handling. But behind the concept of risk, there is a widespread misunderstanding, starting with a failure to capture the concept of singularity. And the world is full of singularities. Even in disciplines where measurement, risk, and forecast are weaved into each other, singularities have an important effect. When Professor Peter Kennedy published a book on econometrics with MIT Press, he used an example in his prologue that really resonated some of these dynamics. And in that example, he stated that to find something meaningful in all that data for forecasting purposes must be so plainly impossible that there will always be endless scope for well-paid advice on how to do it. Yet, despite the ambiguities, we seem to be able to consistently ignore the singularities and even claim that a risk can be neatly calculated as the product of the probability of an event occurring times its impact. Now, effectively, the product of two entities that are both unknown. A brief mathematical joke leads to the conclusion that the root of risk is practically unknown. Now, all the risk-based techniques of the past years in managing the financial system have not prevented the global financial crisis. In fact, it is most likely that they have generated it by providing a comfortable delusional cushion upon which the risk appetites rested, and with them, the beliefs that we can have such a firm handle on uncertainty. But risk is systemic. It is intrinsic to the systems that we use, the systems that we develop, institutionalize, and propagate. As an entity, risk is both subtle and elusive. Any representation of risk, and hence any attempt to break up risk into subcategories, carries the initial risk components unaltered, as in the case of this painting from René Magritte. As with the shards of the broken glass that carry their original function, risk can be broken down to subsystems that never quite lose their systemic risk character. Thus, uncertainty cannot easily be broken down into categories of risk. And even when this is attempted, the uncertainty is merely transferred to these categories, but without losing any of its essence. So all that happens is that risk gains a series of adjectives that incorporate their own distinctions and differences: financial risk, legal risk, structural risk, project risk, process risk, technical risk, and so on. All residual categories, comfortable handles that open the door to the delusion of certainty. But with the concepts of risk and risk management infiltrating every modern socioeconomic and political institution, it is hardly any surprise that some type of risk-based approach would be introduced for dealing with anti-money laundering. And the EU's third AML directive, of course also the FATF recommendations and guidelines around the risk-based approach, have a number of concepts that are utilized for creating further risk issues. Now, even the semantics of it are nonsensical. It must be made clear that there is a general failure in the risk-based approach to accept this. because there can be no such thing as a non-risk-based approach. The word approach itself necessarily includes risk. The word approach effectively demarcates an immediate need to cut down on the complexity in uncertainty and expresses the creation of a distinction that is necessary for any observation to take place. As Luhmann remarks, complexity in this sense means being forced to select. Being forced to select means contingency, and contingency means risk. According to Luhmann, the human approach to risk carries an important function. Since Bacon, Locke, and Vico, confidence in the feasibility of generating circumstances has grown, and to a large extent, it has been assumed that knowledge and feasibility correlate. This pretension corrects itself to a certain degree with the concept of risk, as it does in other ways with the newly invented probabilistic calculations. Both concepts appear to be able to guarantee that even if things do go wrong, one could have acted correctly. Anti-money laundering certainly belongs to a type of system where risk is systemic, in the sense that there is an attempt to control both the interactions that take place within the system for the purpose of improving the AML system itself, and also the interactions that anti-money laundering has with other systems, like the legal system. Of course, the end goal being to reach a successful prosecution of money laundering cases and consequently confiscate illegally acquired assets. Of course, such AML risk is interpreted differently. As an official from an important institution told me once, from an EU member state, and here's a different take on the risk-based approach, he said to me, we would be very, very interested to see what other governments are doing with the risk-based approach to money laundering and terrorist financing and how they're integrating it. And then he said, we would like to call it regulatory arbitrage. Now, governments come under the same roof to create a series of legislative initiatives in order to fight money laundering and terrorist financing, but at the same time, they remain concerned that too stringent legislative provisions could deprive them of business. The Foreign Assets Tax Controls Act is another example towards that direction. Now, the third EU directive, and indeed the FATF itself, recommend a delineation into high and low-risk products or services. For instance, private banking, correspondent banking, wire transfers, e-banking, etc., are all typical examples of perceived high risk for money laundering. Similarly, high-risk customers are also considered, for which typical risk-scoring systems can be created, and the list goes on and on. For example, all cash-intensive businesses, retail, restaurants, second-hand car dealerships, non-profit organizations like charities are increasingly being manipulated by launderers. Thus, this group of high-risk customers should head the list of those being reported. But the fact that we can designate such categories does not necessarily mean that such categories can automatically incorporate the totality of a single category, for example, high-risk customers. So this is one of the key issues with the risk-based approach, because there is nothing intrinsic in any of these categories that can force them into being designated as high risk for money laundering. Any category can, at the same time, be both part of the high risk and low risk assessment process. For example, if we take a cash-intensive business like a retail store as our category, once one defines that to be a category, then it is inevitable that varieties within the same category, namely different retail stores, risk subsystems in themselves, will be part of both high and low risk assessment processes regarding money laundering. Any category itself is therefore a risk-based hybrid. When the category opens up itself for classification, as being either high or low risk and assign the probability, it cannot resist being simultaneously part of both high and low risk areas. And this simultaneity owes its nature to the malleable characteristics of risk itself. So to deal with the risk-based approach within the context of AML, we need context-sensitive data that will act as second-order proxies for determining risk levels of risk categories. And location is one such example that can be used as a second-order proxy. In fact, it can even be used by financial intelligence units as a feedback mechanism to the reporting entities for this purpose. And the US FIU, FinCEN, analyzes SARS filings for building up geographic hotspots of financial criminal activity and then shares those with the reporting entities. These are known as HIFCAs, or high-intensity financial criminal areas. Now, in broader terms, we need to have a way where different proxies for monitoring parameters for money laundering behavior can be synthesized between them in order to designate this difference between high, low-risk categories. Those financial institutions that have ceased to look upon their AML function as an isolated subsystem that deals with particular controls are doing much better in dealing with money laundering, because behavioral modeling that integrates data from the marketing department of the organization at demographic level and or even the sales department has yielded some interesting results in how money laundering behavior is modeled. Now, as I'm gradually bringing this talk to an end, I would like to stress that there are other important changes at play, and these shape the dynamics of money laundering that are bound to create many challenges for the future. And of course, the future of money laundering is also dependent on the changing nature of money itself. Now, the evolutionary process in the nature of money has seen important steps, and the transition from commodity to contract, you can see at the bottom it says $5 silver, and then to fiat money has been one that has gradually detached the intrinsic value from the medium of exchange. The foundations of this trust base that institutionalized the nature of fiat money and transmuted paper into gold has indeed been one of the most amazing acts of alchemy ever. But this type of alchemy is now being constructed by multiple value-based ecosystems through the internet. The explosion of virtual currency is such an example. In China, virtual currency has exploded as a phenomenon through the highly popular QQ coins. And these coins were introduced originally through the instant messaging service of QQ, currently numbering about 813 million users. This explosion has been assisted in part by the unpopularity of credit cards in China. As the Wall Street Journal reported, a Chinese internet company called Tencent Holdings Ltd designed the payment system in 2002 to allow its 230 million regular registered users to shop for treats in its virtual world. Now, virtual currencies are in use in many countries, but nowhere have they taken more deep roots than in China. And QQ coins were originally offered for transactions of cyber goods alone, but as their popularity increased, online marketplaces started accepting the virtual currency for real goods. And this resulted in a rapid rise of the QQ coin and prompted a reaction by the Chinese government as circulation and trade of the real currency strictly controlled. And the government feared a destabilization of the formal currency if the effects escalated. According to the Wall Street Journal, 14 Chinese ministries and China's central bank together waged the QQ coin crackdown of sorts calling on companies to stop trading them in order to prevent money laundering. Now, the changes coming from such payment ecosystems are just beginning. The rise of non-face-to-face interactions will obliterate physical transacting, what is currently the most successful way of identifying suspicious behavior for money laundering. Only 30.2% of the global population is currently online, and a tiny fraction of that has access at the moment to e-banking facilities, let alone placing funds in virtual currencies. Meanwhile, the pace with which some changes are considered within the AML system is causing concern. Taken that it took the FATF 20 years to consider even including the monitoring of domestic politically exposed persons as compulsory, I think speaks volumes about the conditioning of this particular bureaucracy. Meanwhile, the party goes on. Thank you for your attention.
Thank you for an interesting talk. Could you go into a bit more detail about the 6 categories of risk that you outlined, please?
You mean the slide with the legal financial risk?
That's the idea, yes.
Well, this was used as an example to illustrate the different types of risk that break up, if you consider risk as a system, that break it into subsystems, but subsystems that do not lose any of the risk properties. So I essentially used it as a metaphor, as an analogy that's similar to those different categories of risk. If you're dealing with a domain like anti-money laundering, and you've got to break it up into smaller parts, because this is effectively what we do and what we have to do to make it more manageable and more practical, that we need to find mechanisms that where different data can be combined from different categories of risk and different proxies to allow us to synthesize a better description of some of these risks. The problem, of course, in this particular case is that the nature of the phenomenon is difficult, and many financial intelligence units, in fact the vast majority, refuse to give feedback to the reporting entities that submit the suspicious activity reports. So I think this is, so you've got a series of reporting entities that are effectively isolated from various feedback mechanisms.
Paul Shari, that was indeed most fascinating. There are so many questions I could ask, but if I could roll it into 3 that link together. Would we be, and I've been provocative intentionally, would we be wasting all this time and effort on anti-money laundering if it hadn't been for 9/11, which was unique in being a sort of attack on American soil? Secondly, would Guy Fawkes have been more or less likely to be caught out under the present regime? Mm-hmm. And the third one, for the future, it seems that anti-money laundering is a growth industry, and would this not be the best thing to do for one's own profession? Join the trade.
Well, I'll start with the third. I think you can always switch, if you find opportunities in one or the other. But look, I think it's fair enough to, in order to respond to your first question, to make the assertion that in terms of dealing with counter-terrorist financing, that it has been, to a large degree, a waste of time and money. I think the intelligence agencies are much better equipped to deal with the problem, and the only thing that works, at least from the feedback that I have got, is the confidential briefings of MLROs from intelligence agencies. But the fight against money laundering preceded considerably 9/11. So the introduction of the basic 40 recommendations of the Financial Action Task Force took place 20 years ago. And many different conventions, like the Vienna Convention, started and propelled drug-related offenses as predicate offenses to money laundering was even before that. So I think my view is that this assertion could be valid for the case of counter-terrorist financing, not so for anti-money laundering, which preceded that.
Christophe Hamez, Dow Jones. Dionysios, we've heard a few comments around, wasting time and efforts, but if you look, I mean, my only opinion is that whilst one can question the effectiveness of regulation, if nothing else, having more regulation is making life a bit more difficult for criminals, which can only be a good thing. But if you look at, we talked about AML or money laundering, and then there's terrorist financing, but there's also fraud, there's also other type of financial crime, and corruption, or the fight against corruption is another good example. But what we hear a lot in the work we do is banks primarily talking about the holy grail of convergence, of managing different risks. What's your view on this becoming a reality in years to come?
I think the issue of convergence is a trap in some cases. I think there will be areas where convergence will materialize, but there's been a number of cases. Well, if you take fraud that you mentioned, for example, there have been a number of cases of financial institutions that attempted to consolidate and converge fraud and money laundering operations, for instance, for a better handling of those. And I think it didn't play out quite as well. So I'm not saying that there are no possibilities for consolidating data and using that to either profile one or the other, or, as I said, in terms of a behavioral modeling perspective, utilize some for the modeling of another phenomenon which falls under the umbrella of a broad financial crime definition. But I think the current system as it stands has not evolved to that level that you're describing. It could evolve because we're now seeing, as you mentioned, the bribery focus. Corruption is another important element that will come into the equation. So, I mean, my view when it comes to the aspect of convergence, at least in the monitoring side of it, is how, from a compliance officer's perspective that needs to sort of jiggle all these different legislative initiatives that come under the ways, is how to be able to synthesize some of these elements and, in effect, tackle, through a modeling perspective, the financial crime areas or issues like corruption and bribery, which are becoming increasingly important, in a more consolidated way. But I think there's quite some way to go before we get there.
Well, thank you for those questions. Firstly, as you know, we pride ourselves here at Gresham on ending on time as well as starting on time. Dionysios has kindly agreed to stay behind and sign, as I said earlier. Just before we close, I thought I just might share a somewhat disturbing story about the paradoxes that Dionysios highlighted. When I was doing some research on this, we had a large country to the west of here with an accent similar to mine of people coming over, and they actually had a gentleman who came over to beat up our local government to provide them with all the SARs. And I was dealing with this, and it transpired during the course of this that they weren't looking at the suspicious activity reports at all. I said, well, I'm sure you're a very dedicated official, but why are you constantly beating up people to provide you with suspicious activity reports if you don't look at them? Oh, we might look at them one time. I said, I'm sure you're a lovely man, and you probably go home at night and go through a couple of thousand in the evening, which is what it would take, because you're dedicated and committed. All right. He said, stop making fun of me. I said, well, why are we doing all this? He says, well, if it prevents one more 9/11. I said, well, it's hardly going to prevent a 9/11 if you're looking at them after the fact. He said, but it'll be good for the forensics. And this actually, sadly, is a state that I think you get into as you dig into it. It led me to write a somewhat long piece afterwards called Anti-Money Laundering. And it's not that I support terrorism or fraud or theft or criminal activity, but the system, I think, is broken. And what Dionysios, I think, highlighted today, if there was one point I took away, It's that we have no feedback, and until we generate that feedback, the system has its problems. We could have gone on. It'd be a lot of fun to poke fun at whether it's really tax that's motivating a lot of this, or if you know the origins of FATF and things. But I'll pause there and say it's been wonderful to have Dionysios get us right into the heart of a deep and technical subject here in the city, where it does matter to all of us, and where I think all of us would like to get it right. But the first bit in getting something right is to admit what's wrong. And you've done a wonderful exposition of what needs fixing, so thank you very much.
For more information, please visit www.gresham.ac.uk.